For years, cryptocurrency in Turkey has operated as a completely untaxed, unregulated sandbox. Investors could buy, sell, and trade with absolute freedom, keeping every lira of their returns. That era is coming to a close. A newly drafted legislative framework is set to take effect, officially bringing crypto assets into the national tax grid, starting with incomes generated in 2026. This legislation hinges on a severe structural disparity. The final tax bill depends entirely on the specific exchange an investor chooses. One path offers a highly streamlined process, with zero manual paperwork and a low 10% tax rate. The other path requires complex annual filings and taxes that can eat up 40% of total profits. The difference between keeping the majority of your money or handing nearly half of it to the state comes down to one single decision: which digital exchange platform you choose to use. The draft introduces a single rule that applies to everyone. This diagram shows a unified crypto asset. When you sell or transfer a token, a microscopic piece of it, specifically 0.03%, is automatically shaved off and sent to state revenue as a transaction tax. The real divergence happens with the income tax, beginning with what we'll call the local investor, someone who keeps their assets strictly on Turkey-based exchanges. If you stay local, the state caps your tax burden at a flat, predictable 10% of your total profits. The local exchange handles all the heavy lifting. Every 3 months, the platform calculates your profits using the first-in, first-out method. First-in, first-out is an accounting method that assumes the first coins you bought are the first ones you sold. Once calculated, the exchange automatically deducts the 10% tax. Because the platform withholds the money automatically, individual local investors are completely exempt from adding these crypto gains to their annual personal income tax declarations. Corporate accounts, however, are an exception and still have to file. The state rewards investors for using domestic platforms by absorbing the administrative headache and locking in a highly predictable, low penalty. Now let's look at the foreign investor scenario. This applies to anyone holding their assets on international platforms, like Binance Global or Coinbase. The Turkish government has no jurisdiction to force a foreign company to automatically calculate your profits or deduct taxes on its behalf. Consequently, the legal burden falls entirely on the individual. You are now required to manually track every single trade, calculate your own profit margins, and file a detailed annual income tax declaration yourself. This chart compares the tax impact of both choices. Because your foreign crypto earnings are legally classified as standard annual income, they are subject to progressive tax brackets that scale up based on your income, maxing out at 40%. Additionally, if you lose money on a trade, you can only use those losses to offset other crypto gains within that exact same calendar year. You cannot carry a bad year forward to lower your tax bill in the future. To escape this foreign trap, you can transfer your assets to a local exchange. However, to do this, you must officially declare your cost basis, the original purchase price you paid for the asset, to the new Turkish platform so they can accurately tax your future trades. Utilizing a foreign exchange transforms a simple investment into a massive administrative liability, risking a potentially devastating financial loss under the new framework. When we step back from the individual forms and percentages, the broader economic architecture of this draft legislation becomes clear. The 30% gap between local and foreign tax rates is a deliberate behavioral mechanism designed by the state. This diagram illustrates the intended flow of capital. By leveraging convenience and extreme tax incentives, the government intends to force capital out of international platforms and trap it securely within the domestic financial ecosystem. While this framework is currently a draft, its target activation applies directly to incomes generated in 2026. The window for portfolio restructuring is already closing. Turkish crypto investors must evaluate their portfolios immediately and decide if the technical features of a foreign exchange are truly worth a 40% tax premium and a mountain of paperwork.